She thinks 2008, 2009 was bad. The amount of stimulus that's been propping up this economy has been so much bigger than that period prior that whenever we do see that turn down, it could be unbelievably nasty. We're getting to a point where my S&P target is very, very close. My NASDAQ target, which we looked at early on, is very, very close. And if those turn down, we should see just a void of buyers, kind of even some sellers coming out of the woodwork on Bitcoin. I still am in the camp that at some point that nasty recession out there is lurking and it'll come.
Gareth Soloway is back. He is the chief market strategist of Verified Investing. We will be following up on Gareth's 100K Bitcoin call. Finally happened. What's next for Bitcoin? What's next for stocks? The S&P 500 is up at 6,000 points once again this week. Gold is up today, trading at 2750. Bitcoin's up another 5%, inching back towards 100K of fell. The NASDAQ is up. Everything's just up, and treasury yields as well. So the entire market just seems to be euphoric, except maybe the bond market. We'll talk about why with Gareth next. And today's CPI data release and what that means for investors. Welcome back, Gareth. Good to have you end of the year. Welcome.
Hey, wonderful to be here, David. Thank you so much for having me, buddy.
So much activity this past 2 weeks. Let's just start with today's CPI news. So annual inflation rate accelerates to 2.7% in November. That's a little bit higher than the last number. So the consumer price index showed a 12-month inflation rate of 2.7%. Month-to-month is 0.3%. Excluding food and energy costs, core CPI was at 3.3%. And 0.3% monthly. So actually, we're getting further away from the Fed's 2% target. What's going on?
Yeah, so I think you're bringing up the perfect point, and I think this is a point investors have to be aware of. It also shows the euphoria in the markets, how, you're actually seeing inflation go up, right? So last month, it was 0.2% month over month. This month, it's 0.3%. But because it met expectations, the markets are saying, yay, this is fantastic. We also saw the odds of a rate cut for next week actually go up, even though inflation is creeping up. And same thing with the year over year number. Last month, it was 2.6% inflation. This month, it is 2.7%. So higher inflation is not scaring away investors because it's not as bad as it could have been. And that, again, just shows you how investors are really kind of thinking about it. As long as they're going to get that Fed rate cut, they're willing to continue to pump money into the market. My biggest concern with this is whatever happened to that 2% mandate on inflation, because now we're moving in the opposite direction, heading towards 3%, yet the Fed is still supposed to cut rates here next week.
Well, that's the thing. Maybe after next week, they might pause. I mean, yeah. We'll see what happens after the FOMC meeting, but presumably this would be very bad news for the markets if they do pause.
Yeah, I think the markets aren't really fully pricing that in, maybe not how long they're going to pause. And I think also part of this pause is going to be, let's wait and see what these tariffs do. And Trump just said last week, he said he wouldn't guarantee that prices would not go up if he imposes tariffs on different goods coming from China, Canada, Mexico. And I think that's something that investors are not fully recognizing, is that tariffs are inflationary. And so you have to think that the Fed has to be very careful here in continuing to do more rate cuts after this next one, just in case we see inflation surging even faster than it already is.
Trump also said, just sidetracking, he said that he would not force Jerome Powell to quit. He said to a reporter, if I asked him to, he probably wouldn't leave, but if I told him to, he would leave. And then the reporter said, well, are you going to tell him to do that? No, probably not. So I don't know what that
means. That's the old adage of making sure that he wants to show that he's still in control and he's the boss, which I totally get. But again, from what Jerome Powell said, that even if he was told to quit, he probably wouldn't quit. But that's the same thing. It's kind of like ego versus ego here. And we are as investors just get to see what happens from the rubble.
Okay. So from this higher inflation print, what do you expect the markets to do in response to this into the new year? Let's suppose, I'm not saying it will, but let's suppose this trend continues, right? One print could be an anomaly, two is a trend. Then what happens?
Right. Yeah, I think if we get another print next month that's higher, the markets are going to start to get very wary and understand that, hey, this is even before we get any sort of tariff implications, that inflation is moving up. And it really does put a curb on the housing market, because at this point, even interest rates are not going down, even with the Fed cutting. And ultimately, again, that means housing is going to do kind of more poorly in terms of price action and upside. So housing is going to suffer. The economy, it will continue to slow the economy. We've seen seen rates come down off of their recent highs, but they're still elevated to the 3.6% that the 10-year was not that long ago. In terms of the market, I'm still seeing a little bit more upside into year end, but we are close, folks. I have a major cycle date for later this week, or I should say later this month. That cycle date is based on multiple factors coming together. And then if I show my chart here, I'd love to show this chart of the S&P 500. This is my max upside target here. And again, what's amazing about this chart is it's a trend line that begins back in October of 2023 on October 26th. And look, it literally, you had price go away from the line. It came back, it hopped on it, went away, hit it again, went away, hit it, and finally broke. And then look at this. Every time it comes back up to this line, it gets rejected, 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 rejected. This, to me, is your upside max on the S&P going into this key cycle date. It's around the 6170 level, so it's about 80 to 90 points away. But I could see this in the next week or two, us hitting this, and then this would be a major stopping point. In addition, one more thing I want to show you, David, here. Look at the NASDAQ 100, or actually this is the NASDAQ composite. If you take a line from the COVID low in March 2020 and connect it to the bear market lows in 2022, and you extend this parallel up. So remember, this is basically starting with the trend line right here. You drag a parallel up. What do we know? Right up to the high of 2021 bull market. And look at how close we are to this trend line. Based on technical analysis, probability, and data, it tells us that you're likely to see rejection off that level. That's at around 20,150 on the NASDAQ 100, which is only about 120 points away.
Did you know that the average person spends over $200 a month on unused subscriptions? I was shocked when Rocket Money found subscriptions I'd completely forgotten about, saving me money instantly. Today's sponsor, Rocket Money, is an all-in-one personal finance app that helps you cancel unwanted subscriptions, lower your bills, and manages your money better, all in one place. It's simple to use and has helped save customers up to $740 a year using all of the app's premium features. I love how Rocket Money makes canceling subscriptions easy. Once you connect your accounts, it identifies all your subscriptions in one list. With just a few taps, Rocket Money then cancels anything you don't need. Plus, their budgeting tool is fantastic for tracking expenses and helping you stick to your financial goals. Take control of your finances today. Go to rocketmoney.com/David Lin in the link down below, or scan the QR code here to get started today and sign up for free. Can you just walk us through the logic of drawing trend lines and how you come about picking a beginning point to start the trend line with?
Yeah, absolutely. And that's great for educational purposes. So what you want to do as a technician of the charts is you want to find major pivot lows and highs. And essentially what you generally want to do is connect lows to lows. So for instance, a major pivot low is going to be where a market was trending up here, like before COVID, and then it had a major drop. And then it went back to trending in the opposite direction for a long period of time. So very clearly, this was a massive drop, massive reversal, and that gives you a pivot low. Then you look at like a major low of a bear market. And this was, again, if we look at this low right here, right in here, this was a major low from a big fall to a big rise that gives you a secondary low. And what I do is I literally just play connect the dots, like I was 5 years old again with one of those little books, and we just connect the points. And so we take this low, we connect it here, and I drag it all the way out. And then I say to myself, well, let's see what this shows us. And I drag that parallel up, and lo and behold, look at this. If this worked as a high and this worked as lows, we can summarize that essentially it has a decent probability of being a high point where we should see a pullback in the markets. Now, how big of a pullback? That's the question. We don't know. But ultimately, there should be major technical resistance at that level on the NASDAQ.
Okay. But if we were to maybe start from an earlier trend line date, could we maybe analysis that maybe there's more room to climb up?
Well, see, that's the bigger question, right? Because what you could do is you could take this low from February. We could go even, let's even erase this and just do some examples here. Let's go to our weekly chart, right? So on the weekly chart here, what we can see is that if we take this low, here's your 2020 low. If we draw this here and we drag this out, this would be a major downside. So let's just say we get in another situation where the stock market starts to collapse and we get another 2008. Well, where would our likely support be? It would be right here at this trend line. Now, this would be a 50% drawdown in the NASDAQ. The reason why I'm drawing your attention to this line, and I think it's major, is it because it literally connects every major low going back to 2015 to 2016, right here, through here, through here. But look, see the low here in 2022? If we take that low and we draw a trend line straight out, the two lines merge. And one thing I've learned in technical analysis is that when you have multiple trend lines coexisting in one spot, if price comes in there, it's as if you had two walls instead of one wall, or two floors in this case instead of one. It's much bigger support. And so right here, I would, again, I don't know if the markets are going to drop this much, but if we ever did, I would be a buyer like crazy right at this level.
You wouldn't sell even more? I mean, if you fell already that much, wouldn't that be an indicator for just a really strong bear market? And you probably...
Oh, it certainly would, right? But in the thought process here is that if you've fallen already 50%, you at least could start dollar cost averaging in on a position, right? We know that over the longer term, markets tend to go higher. And so what we want to do is we want to say, okay, well, where is a logical, not emotional? Emotion is what most people trade with. We want to look at logical levels to start accumulating. And you're right. Could it go right through this line? There's always a possibility of that, right? So maybe there's a 75% chance you bounce here, but there's still 25% it continues down. And so what I would do as a trader, I would start marking off previous pivots. So here's your high just before the COVID low. Here's your secondary high below this. And if you dollar cost average along the way, inevitably you'll find the bottom at some point and be in a great position for some upside momentum.
Let's leave that chart up. And I want to just circle back to the economy and tie this into this chart. So today's CPI report, most of that came from shelter costs. So the November CPI increase was mainly, according to the data, mainly driven by shelter. And as you know, the shelter component is just rent, owner's equivalent rent, which is a survey of asking homeowners what they would do with rent. And most people in that survey answered that they would not lower rent. Why do you think housing is just stubbornly sticky upwards right now, despite the fact that the Fed is cutting rates? Mortgage rates actually in the US and in Canada, for that matter as well, have been going up in recent weeks, not down.
Right. Yeah. Mortgage rates, no doubt about it, have been sticky and it's been really tough. And so I think what you're seeing here in the rental market is that at this point, based on the cost of homes, it is much better to rent. You don't have homeowners insurance, which at least for me in Florida just keeps going up because of hurricanes, right? Over and over. Taxes, real estate taxes, upkeep of the home, mortgage payments, all these things. And so it really makes there be kind of a decent demand for rent continuing to keep those rent costs high, which again has been a sticky point for the inflation number. And then on the other side, the thing we should look at here is look at the XHB here, the housing, the home builders. XHB, this is actually beginning to come in quite a bit. Let me get rid of these old trend lines, but you actually have a setup here that is actually very, very bearish. So the home builders, in fact, I saw Barclays downgraded. I believe it was Barclays downgraded the home builders I think it was either today or yesterday. And you're now seeing a top being put in. You have a beautiful kind of M double top right here. There's your double top. If this breaks, the home builders are really going to start to slide lower. And I do have it projected out that housing prices are coming down significantly over the next couple of years. Just remember, housing is a very slow moving asset. I think we've all become addicted to crypto moving so much, stocks just continuing to move. But the home market, the housing market, it literally takes years to move. If you think about how long it took in 2006 to 2007 and even into 2008 to put in a top. And then really, when did housing recover? Not until 2012, really. So, I mean, it took years for it to really put in a bottom and start to rally up. So it's just a very slow moving market. But I do think home prices are coming down. Rates are going to be sticky because of inflation, and it's going to be a tricky economic picture as well.
Okay, let's tie Bitcoin in with stocks. If you pull up a Bitcoin chart, people were obviously euphoric in the Bitcoin community about the 100K Bitcoin. Is this move upwards a representation of this return of animalistic spirits, this return of risk-on sentiment that could potentially translate into the equities markets? And then we'll get into this Bitcoin in particular.
Yeah, there's no doubt about it. I mean, you see stocks like, I mean, there's so many countless stocks that have made such massive moves. Palantir, AppLovin. I mean, all of these. Tesla right now is animal spirits. Again, if you look at that, yes, you could say, okay, Tesla will come out with these self-driving cars. It'll be great. We don't even know when that could be. I mean, it could be 3 years, 5 years. Investors are willing to pay a premium right now just to be involved in Tesla. Interestingly enough, just to switch over to the Tesla chart, look at where we are. We just are piercing a double top. So for me, this is actually now becoming a short as a swing trader on Tesla, piercing this double top. Look at this trend line up here, coordinating right with that level. Only as a shorter term swing. I don't know where this will be in 2 years from now, but short term, very, very extended on the markets. Now, going back to Bitcoin, 100% animalistic tendencies. It's also the fact that Donald Trump has been a fan of crypto. Many people in the administration, the new SEC chair that's going to be put in, these are all people that have kind of awakened the animal spirits of cryptocurrency. We've seen Ripple go up immensely, so many other coins. And again, I think that as long as the economy does well and the stock market is doing well, then crypto is going to do amazingly well. But what we did see is the last couple of days, Bitcoin fell when the stock market fell. And so people just have to be very aware that if we do get in a tricky position for crypto, or I should say the stock market, you should expect crypto to come back in. Having said that, when I was last on with you, I said we were going above 100K, and that's what we've done. And I'll go into this chart, whenever you want to kind of go over the crypto outlook.
Well, is Bitcoin going to fall now that we've reached 100K? I think that's the question that everyone wants to ask you.
Yeah.
Is this the ceiling?
So what we have here, I want to show you guys this. So see, we're in this little parallel. So as long as this parallel holds, you have a bullish bias on Bitcoin, meaning that notice how the low end of the parallel, every time it kisses or hits it, we get a bounce. In fact, the last 2 days, look at the low of that right there. It should go back up here. So I have a 107,000 to 108,000 price target on Bitcoin. I think once it gets there, that's where things get messy and we could see a bigger corrective move. And I'll show you why. So now let's just zoom out on this chart. You can see this kind of weird gray bluish area here. Let me go to my weekly chart. If we go out to our bigger time frame, we were talking about parallels and drawing trend lines earlier. What we can see is if you take the 2017 high and you connect it right through the 2021 early high to the exact high of the 2000 late high, that line extends out. And guess what? It's right at that 107 to 108,000 level. Then what I like to do is I say, okay, well, I have a trend line here. Now let me see if it has teeth, right? So does this line have teeth? And so I drag my parallel down and I say, holy cow, look at how the two lows right here during the bear market coexisted right with that line. When you get a parallel to match up, it actually tells you there's teeth to this line, and this line will be major, at least probability wise, it should be major. So for me, I say upside still, 107 to 108 is where I start thinking about selling or shorting Bitcoin.
What's the level that it could go down to and prompt you to start buying again?
Yeah, so for me, it's a retrace to the scene of the crime. It's one of my favorite trading opportunities. When you basically have a move up and then a long base of consolidation, which is what we saw from March on Bitcoin all the way to basically November, that high would be a return to what we would call the highest point prior to the consolidation. So for me, and a lot of people will say, oh, it's never going to go back there. But let's be fair, Bitcoin has a history of big corrections. I would be a buyer at 74 to 75,000 for your next leg to the upside.
Okay. I'm going to switch over to my screen now, and I'm going to attempt to draw a few trend lines and do some analysis of my own. I'd like you to evaluate what I'm saying. I'm trying to learn, Gareth. I'm trying to learn. And then I'll switch over back to your screen. So I do have a question about this. Take a look here. This is Bitcoin going all the way back to 2017. Let's draw a trend line from the top that would extend here. And let's draw a trend line. So that would point to roughly what you're saying here, like a bit more upside on Bitcoin. But if you actually look at how Bitcoin has performed over the last couple of years, it seems to me that the top of the previous cycle happens to it could just be a coincidence, but it happens to be somewhere close to the bottom of the next cycle. Yep. Right. So here in 2017, we've got it topping around 19,000, and of course we know that Bitcoin bottomed somewhere around 17,000 in 2022. If you go all the way back, similar thing happened. I'm just wondering whether or not the same kind of pattern could be applicable today, where the bottom for this current bull cycle is the low for the is the top rather of the previous bull cycle of 2021, meaning 69,000 is the floor for this current cycle. Does that make sense?
That makes absolute sense. And what I love about that, so basically as a technician, when it pulls back, I don't want to miss the next bull run, right? So what I'll do is I'll start buying at 74, which was that previous high, but I'll also DCA down to that level or even below. And so I think for me, at least the way I trade is I usually say, okay, I'm going to invest, let's say 100K in Bitcoin.
Right.
I'll put 25 to 50K in at the first level. And then if it dips to that next level, I'll add the second half or second next quarter position at that level. Because I think you're absolutely right. That's a great observation. And it gives people a range to where it's starting to accumulate, right? From 74 down to about 66 or 69 even, which was the high of that bull market in 2021. So that makes a lot of sense.
I mean, it's possible that what I'm doing now is just pure coincidence. I mean, is there a technical explanation for this, or am I just drawing lines randomly?
So what it is believe it or not, it's psychological. So and this is how markets behave. Markets are ruled by investors that are emotional. And so what you see is that when you get down to a level where it topped out in 2007 in the last cycle, a lot of investors think, wow, it's all the way back to that level. Psychologically, you want to say, okay, this is a time to buy, and you'll see more people accumulating there. And just by the nature of more people accumulating, it can form a bottom, especially when it's so oversold at that point. You'll also have shorts that will then want to cover right in that range, knowing that that will be support as well. So it's a lot of psychology with levels like this.
So $107,000, $108,000 is the upside for you. Why did we pull back from $100,000? Again, a psychological level, a lot of selling around that level, I understand, but wouldn't you expect that psychological level breach to precipitate a lot of momentum upwards? In other words, it would just stop briefly at that level and then just skyrocket more continuously. That's not what happened. Were you surprised that that's not what happened?
So generally when this is again, when it comes to psychology, how things work is, so when you have a situation where you break an even number, right? Think about what happens is anyone who was on the fence on Bitcoin, all of a sudden gets super excited and says, oh my gosh, I'm going to miss the next run from 100 to 200,000. And they jump in. Once those people that were kind of on the fence about buying get convinced to get in, who left is there to get in? And I'm taking a simplistic idea here, but the idea is you coax the last people that were on the fence to buy, which means there's a void of buyers. In addition, you also get the shorts that had probably put their stops just above 100K to stop themselves out. They get stopped out, which is that extra firm buying pressure, right? When a short stops out, it has to buy back Bitcoin on the other side. And so you get this culmination at these even numbers of this kind of big rotation where you get the max amount of bulls on board, leaving this void underneath. And that's when you get these pullbacks at these even numbers. It's actually one of my favorite trades in stock trading, crypto trading, is to either buy at a pierce of even number, knowing that it's a washout, or short at a pierce above that even number, knowing it's max euphoria. Now, again, I still think Bitcoin's going higher here, but in the short term, that 100K pierce, you can see what happened that day. Look, we ran up to 104,000, and then it was like a vacuum. It was like an air pocket where it flushed down to 92 before recovering, because there was a void of buyers underneath that level just for a short amount of time. All the shorts had been stopped out. The major buyers that were on the fence got in, and there was no one left for a short amount of time.
Yeah, and actually, if you take a look at Bitcoin in a log scale, if you use a Fibonacci extension, it every single 4-year cycle, it tends to go up several times relative to the previous cycle. And each subsequent cycle has less volatility on the upside and downside. In other words, it goes up a little bit less and it goes down a little bit less.
And that makes sense with laws of large numbers. And it also makes sense of adoption of Bitcoin. As Bitcoin becomes more intertwined with the institutional side, there's going to be a little less volatility. That 100% makes sense.
So generally, are you bullish right now on Bitcoin, or are you cautious? I mean, 108,000 on the upside is not a significant move upwards from the current levels for Bitcoin.
Yeah, suffice it to say this is that I'll probably start nibbling on a short at around 108, maybe 110 if it pierces, looking for a pullback, as I do think that not only is the Bitcoin level going to be very, very powerful, but I also think that we're getting to a point where my S&P target is very, very close. My NASDAQ target, which we looked at early on, is very, very close. And if those turn down, we should see just a void of buyers, kind of even some sellers coming out of the woodwork on Bitcoin.
So about another 8% upside for Bitcoin. Could the same analysis be applied for tech stocks, the NASDAQ, or even the S&P 500, another 8-10% before you start taking on some shorts?
Yes. So really with the S&P and the NASDAQ, remember that if for every basically 1 or 2% the NASDAQ or the S&P moves, it's probably about double to triple for Bitcoin. So really we're only talking about maybe 1 to 2, maybe 3% upside in the NASDAQ. And then same thing for the S&P. So if we look at this chart here, we can do a quick measurement and say, okay, from the current level on the S&P to the trend line, there's about 1.5% left, maybe 2% if you assume a pierce of that level like it's done in the past. But it is limited. I mean, upside on the S&P, I do not see it. In fact, I've talked about this before, but I am looking to take a large put position on the S&P when we achieve, or if we achieve, this upper trend line here, looking for a bigger move down in the markets.
So can we still lump Bitcoin with equities next year as kind of a risk on play with stocks? Remember how it's moved very closely with the NASDAQ up until basically present day. Is that still going to be the case for 2025, you think?
I do think so. I think slowly it rotates towards being more of a goldish type play, but it certainly isn't that yet. I mean, gold is thousands of years old as a store of safety. Bitcoin is 15, almost 16 years old at this point. And so it still is a risk asset. And certainly if we get any major fear in the markets, it will be pervasive within crypto and you will see a sell-off. So I do think it's a risk asset still and will be in 2025.
Can you comment on whether or not stocks or Bitcoin will outperform or perform better in 2025? Which asset class do you think has more potential?
Wow. So that is
I'm asking you to
question.
pull the crystal ball out of the closet, which I know nobody has, but hey.
Well, what makes it so tricky is that I expect both to go down in 2025.
Interesting.
The question is which one goes down more, right? I mean, if Bitcoin pulls back to 75,000, that's a 25% haircut. Do I think the NASDAQ is going to pull back? I would say this is by year end, I think Bitcoin is outperforming. I think early in the year, Bitcoin could underperform. And then once people see that the U.S. debt is not being curbed by Doge and by these things, that politicians are just stuck in their old ways of spending money, I do think by end of year, Bitcoin is an outperformer to stocks.
End of the year 2025, Bitcoin will outperform because it'll go down less?
So I think early in the year, it goes down more when the market's correct, because I think, again, there's some fear involved and so forth. Yeah. But I think once we see that government spending is not being curbed, that the U.S. deficit is still expanding, then I think the aspect of being a max run of 21 million starts to play a bigger role, plus adoption will carry it through to maybe be down less than the stock market by year end.
One bearish concern that I may have is that a lot of the promises that Donald Trump has made, which has sparked this rally, may be buy the rumor, sell the news kind of event, whereby over the course of the year, we don't see a Bitcoin strategic reserve implemented right away. We don't see more pro-crypto action from the SEC implemented right away. And it's just disappointment for the
That's what
markets.
I think too. I agree 100% on that. I think that's where the risk early in the cycle or early in the year comes in. Once President Trump gets into office, everyone in crypto is going to be like, okay, day one, do this, this, and this. And I just don't think it's going to happen. In addition, I think it's important to point out he made a threat towards the BRIC nations about diversifying away from the dollar as a reserve currency. And if he were to do that and say, hey, we're going to build a reserve in Bitcoin, I think the signal that sends to other countries is really negative towards the dollar. And I have a hard time believing he's going to do that. I think he'll do other things that are good for crypto, but to take all the steps that he's promising, I don't foresee that happening.
Yeah. And what's your bearish case for stocks, though? We talked about Bitcoin. Why will stocks go down?
So stock valuations are insane. I was actually just analyzing Costco earlier. The chart of Costco is absolutely nuts here, trading at a forward. So right now it's a 60 PE. It reports earnings tomorrow after the bell, on Thursday after the bell. Even next year with a forward PE, it's 50. That is insane. Walmart. I mean, you look at valuations, we are priced beyond perfection. In fact, there's no doubt there's a bubble here, right? And you're starting to see this, right? So many stocks, Oracle's reported. I mean, we've seen NVIDIA report and start to go down. There's a lot of signals out there. In fact, the semiconductors as a whole are underperforming now the S&P and the NASDAQ. And the old adage from my early years on Wall Street was that when the semis lag, the markets are sure to follow. And so I am very skeptical that the markets will continue to go up. The bull case is that the economy is running on all cylinders and everything is good. But if that's the case, inflation's going up and the Fed is going to have to keep rates tight. So if the bear case is, okay, well, let's say the economy stumbles and then the Fed can lower rates. But if they're lowering rates, why are they lowering rates? Is it because of a recession? I still am in the camp that at some point that nasty recession out there is lurking and it'll come.
In 2025, 2026?
Yeah. Listen,
We don't know
I thought
exactly. Yeah.
honestly it would hit by the end of 2024. To be fair, I thought it would hit by the end of this year. It certainly has not because there's so much liquidity in the system. And I think it's important to recognize with the stock market just going up month after month, almost new all-time highs daily, the wealth effect amongst the rich and the people that have a lot of money invested is keeping the consumer spending. While we see McDonald's people, anyone making under 50,000 can't even go to McDonald's anymore. The Dollar Generals, they're suffering because people can't afford those even more. But the high end, which spends the most money, they are keeping the economy going. As long as the stock market keeps going up, the merry-go-round and the music will continue to play. But at some point, it can't. The valuations are getting ridiculous. Inflation's going up today, for instance, and we're still seeing the markets go up.
Let's talk about that for just 1 minute. So we can leave the screen up and I'll bring it back to technicals in just a minute. The idea of a recession, it didn't happen this year. Many people, including yourself, were anticipating some sort of slowdown. We know recessions are normal parts of the business cycle. Eventually it will happen. But the fact that it didn't happen this year, why didn't that change your mind about it happening next year?
Well, so number one is I think the elongation of the spending of consumers has really helped. So as long as you've had the first of all, the money in the system, right? The government continues to spend outlandish amounts of money. That is stimulative, right? So that's even if the Fed is raising rates, which they're not anymore, they're lowering rates, which is stimulative as well. But even if they were holding pat, you still have literally hundreds of billions of dollars being spent almost monthly by the U.S. government that is stimulating growth. The government's hiring a ton of people. I mean, all of this type of stuff is helping the economy keep humming along. At some point, that will end, right? And I think the stock market, once it stops making new all-time highs for a period of time, people will be looking at their 401ks and say, wow, every month I was making 10K in my 401k. So I would go spend. I would spend.
Yeah.
Once they see that stop for a few months, they might say, oh, wait a minute. I better step back here. And that could be the kicker for that recession.
Let's talk about stocks or sectors or asset classes you are bullish on. So short term or medium term, you're bearish on stocks and Bitcoin. We've talked about that. What do you think has potential to go up in Q1?
Yeah, so I'm continuing to be a big fan. Now, what's interesting is we talked about China stocks a while back. They had that massive run. I nailed that run. Then they came back in. I actually shorted some on the way down. I am back to being bullish on China, and I'm going to explain why. So number one, take a look at Alibaba. We talked about the scene of the crime retrace. Look at this. Here's your trend line. You broke out on Alibaba, that monster move up. And then look, you came back. Where did you go? Right to that trend line, tagging that trend line. So now you're basically discounted again. And the reason why, so number one, China's talking massive stimulus. Now they're finally realizing they have to do massive stimulus. That's bullish for equities in China. Number two, Trump has threatened massive tariffs on China. He generally threatens monstrous tariffs and then he imposes something less. It's a negotiating tool. So I think prices on China equities are reflecting a potential of these massive tariffs. My guess is it is going to be a tariff. There's no doubt. He has to follow through on that, but it won't be as high as markets anticipate. That will be bullish. And again, if you add in that China stimulus that they're supposed to be doing, you probably want to start rotating towards these China names again, like Alibaba, Baidu, and some of the other ones.
Because right now it's heavily discounted. Is what you're saying.
Yes. I mean, you have like we talked about. Costco's trading at a 50 forward PE. Alibaba's trading at a 7 forward PE. I mean, incredible discounts, disparities, money flow. Again, yes, there's always the risk of what could happen with Taiwan, but again, that's the outlier. That's always a risk, which was why you have to diversify portfolios. But to have some in on China here at these levels, I love it.
A lot of this rally came as a result of the China bank stimulus. The Bank of China stimulated the economy or lowered rates and did a bunch of other things earlier in the fall, a couple months ago. So that's what that September run up was. And then I guess people sold off because right after that announcement, they made a separate announcement that was very vague and didn't really outline exactly how the stimulus package would be delivered. And so the markets kind of, were disappointed by that.
Short on specifics.
Exactly. And markets didn't like that. So looking forward now, is Chinese equity, since you brought it up, a play on the Chinese economy overall? Because if you look at the Chinese economy this year, the growth has been pretty bad, right?
Right.
deflationary risks throughout the year. Youth unemployment is up. Obviously, there are sectors that well. Obviously, the economy overall is still not collapsing. But um, if we were to place a bet on China stocks, are you also betting on the growth of the Chinese economy?
Yeah, I think it's partially a growth. I think it's twofold, right? So one is that the U.S. equities have absorbed so much outside money that just helped build this bubble in U.S. stocks. In fact, just to throw it out there, the Buffett rule, what he pays attention to is two standard deviations from its norm, right? So that's how extended the valuation metrics are on the overall market. So I think it's partially on the China economy being stimulated enough. It's also, remember, the China's economy has been in a recession basically since COVID, right? I mean, it has never come out like the US economy, which means at some point it will emerge. And especially with this added stimulus, it'll probably emerge. The other side of this trade is thinking that some people are steering clear of China as investments because of what Trump may do. And if I'm correct, Trump, again, his bark is always worse than that bite. The bite, yes, it will come, but it will be less, and markets aren't prepared for that, and that'll be positive for these equities.
Let's talk about precious metals now. Any views on gold and silver and how they would do going into year end? I think year end and next quarter. I think people are wondering why $3,000 was not breached yet.
Yeah, so I think part of it was that gold is for historical purposes. Gold had such a massive move up. I mean, again, we're talking from basically flatlining right around 2000 for a nonstop uptrend until the latest pullback here, which took us to about 2,800. I mean, percentage wise, that was 30+% move on the back of basically about less than a year, from February of this year when we were trading at 2000 to essentially November. I also think that if you look at the high on gold, what does it coincide with? The high on gold was right at the end of October. What happened in November? Trump was elected, which released those animal spirits of risk on, and also Bitcoin took off. And so you had money rotating out of gold, which pulled gold back while Bitcoin was running up. So the thought process here is I still think gold's going above 3,000, but it was due for a correction. You had the factors there with the Trump election win and Bitcoin beginning to take off. And now we're starting to see, with inflation upticking, interest is starting to develop in gold again. Mm-hmm. Notice again how the latest run, we see Bitcoin kind of topping out around 100,000 here, and gold is starting to see money flow again. So I'm still bullish on gold. Doesn't mean it can't pull back, but at the same time, you have this parallel channel again. Look at the parallel channel. We can even get rid of these other two lines. At some point, we go up to this high end of the parallel, which could be close to 3,000 in the future.
Looking ahead, your top asset classes for 2025, what do you think will do the best? If someone were to hold.
So just like we mentioned, I would have to stick with China stocks outperforming, maybe some other global equities outperforming, emerging markets maybe outperforming because they've been so beaten down. It's not so much that their growth is going to be spectacular. It's just that, again, they've been under allocated versus U.S. equities. And then I think you stick with gold in terms of, the safety of gold. Even if gold is down 5% for the year, my guess is if that happens, we have equity prices that are down 25%. And I still think gold will hit in $3,000, that 3,000 an ounce. I still think it's coming in 2025.
What are the major trend reversals that you have to look at in 2025 that would change your mind? I mean, and let's take some history as a guide. So if you've been on the show a lot, you're a regular popular guest, you nail some calls, you haven't nailed some other calls. No one's always right 100%. If you were just to isolate some of the calls you did not get right, why were the surprises that revolved around those calls? Like that wasn't a very well-formulated question, but you know what I mean? Like what happened? Sure. What happened that surprised you?
Yeah, so I think one of the biggest ones is me expecting a recession by the end of 2024, which obviously has not happened. And I think, again, for me, analyzing it and looking back, I really underestimated the amount of liquidity, the amount of government spending in the system, and really the amount that the stock market would carry the consumer to continue to spend that was keeping things running. And again, that was no doubt, that was wrong on that. I still think it's coming in 2025. In terms of gold, we nailed that call per calling it at the beginning of the year as an amazing performer that was heading north of 2,500, and that actually came to fruition. But you're absolutely right. I mean, there are certain calls. I always say, right, there's no one that's a perfect in this game. I bat about 80%, which means I have 2 wrong calls for every 10 I have right, or every 8 I have right. And I think, again, that's the key, is as a trader, as an investor, you have to be able to recognize that, understand why you got it wrong, and then try to do better on the next time. But there's always going to be a call you get wrong.
Okay, so to recap what you said, so your overall macro thesis of a recession this year didn't happen, and so a lot of the bearish calls you made because of that um, was because of the assumption that the economy would slow down and bring down risk assets. Was that what happened?
That's right. That's correct.
Okay.
That's correct. Yep. Absolutely. Absolutely. And again, that's the humming of the system, right? As long as the merry-go-round, the spending, the free money, the stimulus is there, it's very hard for an economy to stall out. Think about it like this, is you can keep someone alive.
Yeah.
Like if you took away the drugs, that person would die in the hospital, right? But you can keep them alive artificially for a long period of time. And that's one of the biggest risks that I worry about for this economy is that it's like a patient on life support, but they're keeping it artificially alive. Is that the cycle wants to have a recession, it's not being allowed to, which means that if and when those drugs finally get removed, or at some point it just starts flatlining and the collapse is going to happen regardless, and it's going to be worse. Promise you this, folks. You think 2008, 2009 was bad. The amount of stimulus that's been propping up this economy has been so much bigger than that period prior that whenever we do see that turn down, it could be unbelievably nasty.
Why would that be nasty? I'm just trying to wrap my head around the logic here. So stimulus is good for spending. Right. I mean,
but the idea is it's a drug, right? It's an addiction. The markets are addicted, which has created this artificial, kind of like in 1920s, the roaring 20s, we saw some of the same lending practices, people using margin, people thinking they couldn't lose and just putting all of their money into risk assets like crypto, like stocks, et cetera. And it created these bubbles where valuations were abnormally high. In fact, valuations right now are now bumping up against the dot-com era valuation. And so the idea is that by artificially stimulating, you're kind of creating this artificial bubble with people kind of being almost lied to, not lied to because we all know what's going on, but just feeling invincible that the party can never stop. Yes. Inevitably, the party will stop. And usually the decline at that point is much, much worse. So for instance, great example, again, not to use the drug thing, but you have someone that's high constantly. Coming off of that is much worse, the down move, versus if you just did that drug once, right? Then coming down, your body's not as addicted. It doesn't have to go through the same withdrawal. We will have to, as a country, as a world, go through a massive withdrawal period from all the stimulus that has gone on.
All right. So stimulus rehab, that's where we're going to go.
That's right.
Gareth, good stuff. Where can we follow you?
Verified Investing, guys. It's the place where we're bridging institutional knowledge and data and technical analysis to retail investors, just to really kind of help people get the same information that I give a lot of the institutional partners that I consult with. The idea is, again, everyone should have a playing field that is even, and to have that access at least to the constant, data and technical analysis. So that's where Verified Investing comes in, and I hope everyone comes and visits us.
Great. Put the link down below. Thank you very much, Gareth. We'll speak again soon. Happy New Year. Happy holiday season. Merry Christmas to you and your family. And thanks for joining the show this year. I'll speak to you again in the new year.
Thank you so much, David. Same to you, buddy. Take care.
Thank you for watching. Don't forget to like and subscribe.